Hi team, welcome to Traders Academy. Today we're going to talk a little bit about stop losses. So let's look at PLM. So PLM opened up at 318, came down, consolidated around the trade line. You got a trade line VWAP cross with an increase in volume here. And then right here it was consolidating above our initial morning high right around this area. So you can see right here VWAP trade line right underneath. So let's just say you took an entry here at 345 per se, 345. Okay, so you buy your stock, put your order in at 345, and now you're in your position. So now let's say you want to put in a stop, right? So your stop should be not where you want it to be, and it should not be where you can risk. I mean, most people say, well, my risk tolerance is 5%, or some people say my risk tolerance is 10%. Well, you want to adjust you want to adjust your position size to where if you do stop out, you do not lose over what your risk tolerance is. So let's just use 5% as an example. So let's just say 5% is our risk tolerance. So in this case, we enter at 345, and we want to put in a stop at about 5%, right? So we can see the support. Where is our support right here? Our support is trade line and VWAP, right? So if you look, trade line is which is an INEMA, is around the 330 area, 329, 332. So then VWAP is 329, 328. So about 330 is where that support line is. Then you look over here at what your initial morning high is. Let's draw a line across that. And roughly about the same, about 331, 330 area. So we know that's a potential support zone, right? So that's what we want to use as our stop. So again, let's just say we enter at 345. So now we know where our stop is. So to enter your stop, you go sell. Where it says limit, you choose stop or stop limit. And this is what we want to discuss some about. So let's enter a stop, and our stop price will be 330. Okay? Time and force, whether it be good for today or good till canceled. Let's just leave it for today. So now we are in the position at 345. If that stock comes down to 330, we stop out and we lose 5% of our position size, right? So now, which actually it's a little bit less than 5% if I'm not mistaken, but it's pretty close. So anyway, now that is a regular stop, or what people refer to as stop loss. Okay, so if this stock came down, let's just say you enter here, and instead of the stock going up and doing this, let's just say the stock comes down, breaks the support, and as soon as it breaks that 330, your stop loss order will immediately convert to a market order, and it will feel whatever whatever the market price is at that moment. It could feel at 330, it could feel at 327, it could feel at 320 if it drops really fast. It could even feel at 315 if it drops really fast. But you are out of that position. Okay? Now, so this is pretty much guaranteed. Now let's go to the next one, which is a stop limit. And a lot of people use a stop limit. I prefer the stop. Regular stop, stop loss, not the stop limit. Why? Let's get into that. Well, now we have our stop price, right? Stop price at 330. Same scenario. We're in at 345. Stop price is at 330, right? But now we have to enter a limit price. This price is the price that you are telling your broker, if this stop area hits, if the stop price hits right here, I want to sell my position for this limit price right here. So let's just say, and it has to be lower than your stock price. So let's just say we want to sell for no less than 325, right? So stop price is 330. We enter a limit price of 325, and then we put in our order, right? So now we have a stop limit of 325. So now what that means is if this stock goes up like this, but then all of a sudden, I don't know, bad news happens, an offering or whatever, um, or just a lot of heavy selling, like this candle right here, like huge selling volume, right? So for whatever reason, let's just say the stock breaks that 330 area, okay? It triggered your stop price, but your limit price is 325. So now let's just say it triggered 330 and it dropped really, really fast to say 320, right? So it wasn't enough time to fill your order because there was just not enough shares available to fill your order at that precise moment, right? So now the stock is trading at 320, but your limit price is sitting over here around 325, right? So now the stock comes lower and it comes down to say 305, and your limit price is still up here because it hasn't come back up to 325. Now if the stock manages to come back up to 325 or 327, then your stop order will fill because it's come back up to the price that you wanted to get out at, right? But if the stock price never comes back up to that area, to that 325 area, well, then the stock can just continue dwindling down, go down to 305, go down to 3, come back up to 310, 311, come back down to 290s, 280s, and just gradually keep going down. And you're over there wondering, why didn't my order fill? I mean, and then a lot of people start saying, well, Webull sucks or Robinhood sucks or whatever. No, it's not. It's not that it's not that the platform doesn't fill your orders. It's that it was too much volatility in that stock, and since you chose a stop limit, your order will not get filled if that price doesn't come back up to that limit price. Now, if the stock just slowly drops to 330, triggers your stop price, and then immediately triggers your limit price, which might be, even better than 325. So, you get out of your position, right? But again, on those unlikely scenarios, which do happen. I've been through offerings before. I've been in a trade. Sometimes they do a midday offering, which I hate, but sometimes they do it. And that's why I also emphasize to always take some profits along the way, because you don't know. This stock right here came up. You don't know that it's going to continue up. A lot of things can happen. Selling volume can come in. An offering can come in, and offerings are, an offering. A lot of times the stock will halt, and you're stuck in that halt, right? So let's just say the stock halted right here. Even on heavy selling volume, it'll halt. So let's just say it halted right in this area, right? 402. So you have a stop limit, 330, your limit price 325. But now the stock opens down here at 320. So your stop price triggered, but your limit price is at 325. So the stock's now at 320. If the stock doesn't make it back up to 325, your order will never get filled, and you will be stuck in that position all the while it's slowly fading, So you don't want that, right? So yes, in a halt scenario, yes, if you have your stop at 330 and you have a regular stop, and if you have your stop at 330, yes, if it triggers, say it opens at 320, and when it immediately opens back at 320, your stop price hits, of course, your stop order hits, which immediately converts into a market order. And so you may sell at 320, right? And Well, then you say, well, what if the stock comes back up? What if the stock comes back up to 330, right? Or 335? Well, you don't know that it's going to do that. Nobody knows. So chances are it's going to continue to go down. Usually when a stock, has bad news or hot like that, I mean, yeah, if you're already in bad and it's already, I mean, your plan was to stop out at 330. You don't want to keep, you want to stick to your plan. You do not want to keep holding that stock. So for me, if I was to use a stop, which I rarely do, I try. I mean, most of the time, I'm sitting at my computer, so I'm watching my positions, and I use mental stops. So I stop out. Now, if you cannot stick to a mental stop, I also suggest to use hard stops, right? But you know, either way, you want to stick to your plan. So if your plan was to stop out at 330, you want to, to stop out at 330. So put in a stop at 330, not a stop limit, because again, a stop limit, yes, it will, what a stop limit will do when the stop price triggers, it will convert it into a limit sell order. I don't want that. I want, when my stop price triggers, I want it to convert it to a market order and get me the heck out of there. So that is the difference in between those stops, the stop and the stop limit. Okay. Now, there's also another stop order that is called a trailing stop. For some reason, this desktop version doesn't have it, but it is in your app, on your Webull app, and a lot of other platforms have it, the trailing stop. So the trailing stop, again, you're in your position. Let's just say you're in your position at 345, right? So your trailing stop, you can choose whether you want a percentage trailing stop or a dollar amount trailing stop. And in the Webull app, it has a little dollar sign and a little percentage sign that you can click on to change it to whichever one you want. But let's just say you're using a percentage, right? So, and a lot of people prefer a percentage because a lot of people, again, they have a percentage stop in mind. So let's use 5% as an example again, right? So you're in at 345, you enter a 5% stop, right? I mean a 5% trailing stop. So what you're telling that your broker is that if the price goes up, and then drops 5%, you want out. You want to sell your position. Okay? So in this scenario, you would stop out around 327, 328 if it dropped 5% as soon as you entered your position. But now, let's just look at PLM, and let's say it came up right on this candle, made a high of 365, now made a high of 358, right? Now made another high here at 397. So now, I mean, your stop is trailing the price of the stock. So now your last high was 397. So now your 5% stop is not at 327 anymore. Your 5% stop would be at 377. Roughly 377, 380, not sure. I have to do the math, but so 397, and if it drops 5% from 397, that's where you would stop out. Let's just say it was around 380 maybe. Where is that? 380? Yeah. So you would be stopping out somewhere in this area, right? So as you can tell, and of course naturally, I would have took profits as soon as it broke out of this pattern right here. I would have took profits, some profits right here. Here it comes. Let's see, 434. Yeah, I would probably took profits in front of 450. Yeah, 453. So yeah, I would took some more profits around this area. But so let's just say we took profits, whether twice or once or whatever. But we done took some profits, right? So, or let's just say we didn't take any profits at all, right? And some people, some people do that. Um, so the stock came up, right? And I messed up there. It wasn't a high of 397. I'm sorry, it was a high of 453. So okay, so 453 stop, 5% stop on that would be about 430, right? Roughly. So you come down to the 430 area. So you would stop out right in this area. If the stock comes up, makes a high of 453, and your trailing stop is 5%, you would stop out right here. Okay? Because even though your first initial stop was 327, the trailing stop, that's what it does. It trails, follows the price of the stock. And it's always going to be 5%. So if the stock comes here and then it pulls away, it'll be 5% from this high of 365. If the stock comes up here and then it pulls away, it'll be 5% from this, not necessarily from this high. I mean, from the highest point of that price. Okay. So it uses the highest point. I mean, the highest price of the stock. Okay. So now that's a percentage stop. Let's just say you want to use a dollar amount. Okay. So let's just say you were using I don't know, let's see, 345, 330. Let's just say you were using a 15 cent, right? 15-cent stop, which is roughly about the same percentage. Okay. So we're in at 345 and we want to stop out if it drops 15 cents, which will be about 330. So now if the stock comes up here to 365 and then it drops to 350, we'll stop out. If it doesn't and the stock continues higher and it makes a new high of 434, if it drops 15 cents again, say 429, you'll stop out again. And same scenario. I mean, it just keeps following the price of the stock, you know, um, as it makes a new high, as it makes a new um, high price on the stock, and then pulls back. If it pulls back down enough to either your percentage trailing stop or your dollar amount trailing stop, then you will stop out of that stock. Okay? Because when it does that, it converts it into a market sell order. Okay? And again, I'm okay with the trailing stop, because especially if I don't took profits and then I put in my trailing stop, because let's just say I have to leave, I don't know, for whatever reason, I have to leave, and I can't monitor my stock. And I don't want to leave it unattended because you don't know what could happen. I mean, again, an offering could come out, a bad PR could come out, or, just heavy selling volume can come in. And I do not want to be stuck in that position and, make a winning trade into a losing trade. You definitely don't want to do that. So, yeah, trailing stop can come in handy a lot, especially if you cannot monitor your position. Again, I prefer percentage. I would probably use a percentage stop, um, especially if you're a newer trader. It would make it a lot easier for you. I mean, you can say, well, I want to stop out at 5%. Okay, so that's max risk I want to take on this trade. So you choose a 5% trailing stop, and as the stock moves up, as the stock makes a move up, and then it comes down. If it comes down 5% from the highest point, you will stop out. Okay. And if for some reason, I mean, if you happen to be watching it and you see something that tells you, well, it could find support, over here or whatever. I mean, you see something, I don't know, or you just change your mind, and since you already took profits, you want to adjust your stop. You can, adjust it to a 10% trailing stop or whatever. But yeah, so I hope that answers some of your questions on the stop orders. If it doesn't, just comment below on the comment section, and we would love to hear your input.